The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and or legal advisors before implementing any transactions and or strategies concerning your finances.
The retirement investing conversation has changed over time. So retirement is lasting a lot longer. People are retiring a little bit earlier, living a lot longer. So we're looking at a much longer time horizon of retirement. We are funding more of our own 401ks and IRAs. Gone are the days where every company was offering a pension to their employees. Markets are more visible and emotionally driven. As I'm sure you know, every time you look at the news or open your phone, there's always something about the market, which people tend to react pretty quickly to. And inflation and healthcare costs remain persistent pressures. We have not seen those prices go quite down yet on the healthcare. So our investment strategy needs to be supporting all the long-term growth and the income for the years to come. So we'll talk about retirement in 3 different phases. So we start with our working years, which is our accumulation phase, the transition point, that's where you start to prepare for retirement, and then we have actual retirement. So phase 1 is the working years. This is when we begin to accumulate our assets. We're buying our houses, buying our cars, starting our careers. This is when we begin to open our retirement accounts. Hopefully we're maximizing those contributions and taking the appropriate investment risk.
So then if we get to the transition point where we're going from building our assets, accumulating assets, then we have to start thinking about when we start to take withdrawals from our accounts. We turn on pensions, we have our income sources. That's why we're shifting from the earning years to the years where we take those accounts and we create our income streams for retirement. And during those times leading up to retirement, as we're thinking maybe 5-10 years out, that's where the asset mix in your portfolio or your household portfolios gets more to take a look at, because we have to be careful of the volatility in the markets. And with financial instruments, we want to make sure that you're not in a portfolio that's going to be too volatile when you go into your retirement years. So that becomes more critical. And then tax diversification really starts to come into play as well. So a lot of people think about diversification as far as buying a basket of stocks and bonds so all your money isn't in one spot, but tax implications with your accounts. So we're going to talk in a bit about different buckets that you can have your money in. So tax-free buckets of money, buckets that are going to be taxable when you take a withdrawal, and then there's going to be some other buckets, but we'll get to that in a little bit.
And then we have phase 3, where we are executing our retirement. So this is when we go from our W-2, our employer earnings, to actually making our income from our portfolio. We start to take withdrawals from our portfolio to support our cash flow needs, and taxes and sequence of returns become key considerations. So with the 3 phases, what question are we trying to answer? And that is, how do I build a retirement portfolio that can support the retirement I want today while continuing to provide reliable income for decades to come?
Okay, so if we start to drill into the details a little more, so when we're in our working years and the primary objective is accumulation, right? We're growing that nest egg as much as possible, or nest eggs. Like I said, we're going to talk about the taxable accounts, non-taxable accounts. The secondary objective, we want to control the risk in each account, right? We want to make sure that we're not too risky, but we want to earn enough so that we're going to be able to make enough earnings and grow our account, our goals in retirement. Maximizing tax efficiency. So when we're in our working years, usually tax rates are higher, right? Or we have that W-2 income. If we have household W-2s, we want to make sure that we're putting money in accounts so that over our entire lifetime, we're paying the least in tax, right? So We want to be careful with our tax buckets. And then flexibility, really important as we get into retirement, because we want to build our portfolios and have our accounts set up so that we can take from accounts to pay for expenses, to cover our goals in a tax efficient manner. So we're not paying too much to the IRS or New York State in tax, both now and when we're in retirement. So if we talk about the investments in our accounts, equities or stocks, those are primarily used for long-term growth, for outrunning inflation. Inflation's been in the news a lot in the last couple of years, seems to be running about 3.5% now. Well, that's 3.5% every year. So that means the purchasing power of our dollar is slowly going down by 3.5% right now this year. So that's a key consideration when we're investing in equities. And in equities, we want to stay invested through periods of market volatility. The most recent one, we've got another war in the Middle East. Big surprise. It's likely going to continue to drive the volatility in the markets, but the key is to stay invested and ride the storm out, really, at least with our equity portfolio. And the most powerful force here is the compounding. So the basic story with compounded equity returns, if we look at, for example, the S&P 500 index, that's a basket of roughly 500 stocks. It's earned on average about 10% a year for the past 100 years. Now that's not guaranteed to continue, but it's a good baseline. So as that growth starts to compound and we're building our snowball for retirement, it's really important to use that piece of the portfolio to outrun inflation so that we can at least keep pace with the that we consume. Then diversification, if we go into that a little bit further. So we want to, if we're thinking about dialing back our risk profile or weighting our portfolio so it's not so volatile, we want to spread our risk across different assets, different types of stocks, different types of bonds. And one thing we really look at from our perspective when we first and we take a look at their portfolios is we want to make sure that there's not too much risk in any sector. For example, the energy sector. Oil and gas has been very volatile recently. We want to make sure that your portfolio isn't too overweight to energy or something that's going to have a wild market value fluctuation, or any individual stock. If you have a lot of money in one stock, it's like having all your eggs in one basket, right? So we want to be and then let's see, part of that discussion involves managing some of that volatility. It's okay to have some fluctuation in the market value of our accounts, right? Because over the long term, if we stick with it, the data has shown that the accounts will recover, things will perform as they commonly do in the past. But we just want to we don't have too much volatility, especially as we're getting closer to retirement years. Okay, so as far as time horizons, we talk a lot about time horizons for people leading up to retirement and then in retirement. So younger people, I'm still technically young, even though I don't feel it, you can stomach more volatility, right? Because we have a longer career, still accumulating assets, more time for the market to recover. And then as we get closer to retirement, that risk profile needs to change a little bit. We need to get into more stable value assets, things that don't fluctuate so much in market value. But the important key to make is that our investment mix or our allocations should never be static. There's a lot of talk around passive investing, and really as you're getting closer to retirement, you don't want to be passive. You really want to take allocations and ensure that you're invested in a diversified manner and that you're invested so that you can eventually reach your retirement goals.
So what are some common oversights during this phase? One of them would be being conservative too early. When you have that longer time horizon and you're beginning your employment and your investing, you have the ability to be a little bit more aggressive. If we start off too conservative, then we're sacrificing that and we're reducing that compounding over time that Shawn talked about, which means if we're investing too conservative too early, we're also at a risk of not being able to reach those retirement goals later on. Another oversight would be ignoring taxes. So missing out on Roth opportunities when you're in that lower tax bracket, it's more advantageous for you then to pay the tax and take advantage of the Roth accounts. And inefficient placement, so putting your assets into the wrong type of investment where you're not taking advantage of the benefits. And emotional investing. So this is what I'm talking about with reacting too quickly to headlines and news and selling in downturns is never a good idea, and chasing performance. So we always say you can't time the market. It's more important for the time in the market. So during time volatility, it's natural to feel a little scared and want to pull back, but that's usually the time where you should hang in there a little bit longer because they do rebound.
Okay, so this is where we get into our different buckets of money for retirement. So we've got tax deferred accounts. Those are most commonly 401ks, 403bs, traditional IRAs where we're not paying tax on that money now, but when we go into retirement and we start taking withdrawals, that's where we have to pay tax on the withdrawals. And depending on your state of domicile, where you live, you may have to pay some tax at the state level too. It really depends on where you're living in retirement. Tax-free, rarely can we say tax-free when we're talking about anything investing related, but that's usually with our Roth IRA accounts. So with the Roth IRA, there's some check box. You take the money out after the account's been open for 5 years. It's usually a retirement account, so it's often withdrawn after age 59 and a half. The withdrawals are tax-free. If we meet all the criteria for the IRS, those withdrawals are often tax-free. So those are great investment vehicles, especially for large lump sum distributions in retirement. So hypothetically, say you need a roof on the house, you can take that money from a Roth IRA, implication. Or if you want to buy a boat in retirement, you can take the money from that Roth IRA and there's no taxable income that lands on your tax return. And then there's taxable accounts or just common brokerage accounts. And that just simply means that each year as there's realized gains in the accounts or in the portfolios, or if there's dividends and interest generated, the tax implications are in the tax year. So those accounts often have a lot of flexibility as well. There aren't as many rules as far as distributions and that sort of thing. So a couple different buckets to work with, provides flexibility in retirement is the main key. Yeah, so like I just said, the flexibility is key with having these different buckets of money, and then along with that, there's pension income potentially, there's Social Security. Just gives us more levers to pull to fund goals and to make sure that you have the retirement that you're looking for. Okay, so as we're getting closer to retirement, the question when it comes to portfolio management, we switch from, how do I grow this nest egg? How do I keep accumulating assets to how do I take all this money that I've accumulated and then take income from it? How do I pay for these things, the trips and the lifestyle I want to have?
So retirees are not just managing their investments, they're also managing income replacement, tax efficiencies, longevity risk, market risk, and your spending needs over decades. Your spending will change. You want to make sure that your portfolio is going to be sustainable through that time. So like Shawn mentioned, we typically have two sources of income in retirement. We have which is our Social Security, pension if you're lucky to have one, and annuities. The other source of income comes directly from your portfolio in the form of withdrawals and interest and dividends.
So keep our bucket conversation going inside of those portfolios. There's quite a bit going on at times. So We often have assets that are allocated for short-term goals or short-term funding. Um, Cash, what we call cash or cash equivalents. So money market funds, treasury securities, think things that are fairly stable in their asset value. So not a lot of fluctuation. Usually, not usually, I should say, often we see a rate of interest that keeps pace with inflation. For example, a lot of money market funds right now, the yields are about 3.5%, which is about where inflation is. So we're at least keeping par with inflation. And the reason to have some cash in that short-term bucket is to fund your short-term goals so that, like I said, if you're looking to buy a boat a couple of years into retirement, we want to have some money earmarked for that inside of an account that's not going to fluctuate much in market value. Um, then in the middle of the road, we've got usually some bonds, some fixed income, things that fluctuate a little bit more in market value. Corporate bonds. They usually pay a reasonable interest rate or dividend, but there's some market value fluctuation depending on interest rate movements and the characteristics of the companies. And then we've got some moderate risk assets. That could be some equities, maybe some dividend paying stocks. There again, the net asset values of those fluctuate a little bit, but they're not as volatile as a full equity portfolio. And then we get to the equities. So that's the stock market gets all the news, right? You can see the stock market on an iPhone now or your iWatch, right? That's where there's usually more volatility, but like I mentioned before, the key there is to have some equities in a portfolio to help us keep pace with inflation over the years. And as long as we have your portfolio structured so that there's these other buckets that we take withdrawals from, if there is a downturn in the market, if we have a recession come along, hopefully we don't anytime soon, but if it's bound to happen at some point, we can simply let the equities work for us, let that money work, let the value recover while we potentially take distributions from other portions of your portfolios. So that's that.
Okay, so in retirement, there's going to be a few risks that we're going to be trying to combat. One of them would be longevity, because like I said, it's lasting a lot longer, and you want to make sure that you are going to have that income for years to come. So we want to take a look at how we are managing our withdrawals during this time so that we can combat the longevity risk. So if you're over withdrawing early on, that's definitely going to shorten your lifespan there with the accounts. So withdrawal order will matter because you want to make sure that you're saving some of those assets for later on and managing, are you taking from the tax-free, the tax-deferred, or the taxable? Because you want to make sure that those are lasting through that time, and the sequence of returns on each of those is going to be different. So a lot of people will like to save their Roth IRAs for the last thing to take from, and they'll pay the tax early on and leave the Roth IRAs for their heirs. So you over the lifetime taxes, and you know that you're going to have RMDs at age 73. So how is that going to impact your tax picture? Does it make more sense to maybe pay some of that tax early on so you have more of that tax-free money later?
Okay, and then we talk about lifestyle risk. What does that mean? Well, unfortunately we're going to keep spending money in retirement. We're going to have taxes in retirement, health. All the expenses keep going for the most part. And the biggest thing we need to keep an eye on there, like I've mentioned, is inflation. We'll talk about that a little more in the next slide, and spending habits. It's a good exercise to run through all your expenses before you get to your retirement years and try to nail down what they're going to be. And some people can stick to their budget. They spend roughly within what we think they're going to. But then we see other clients that really like to spend money, and they ramp up their spending when they get into their retirement years. So the concern really is running out of money later in life when you're maybe in your 80s or 90s. And I always tell clients the last thing I want to do is call you and say, hey, you're going to run out of money and we need to cut your spending back. there's not much I can do about it at this point, right? Hard to go back to work when you're in your 90s. So, okay. Inflation. So these guys need to be quiet because they're driving me crazy. Inflation. So historically, inflation is about 3% per year, like I mentioned. But when we're doing a long-term cash flow analysis for folks, healthcare is one that we usually inflate at about 6%. Healthcare has been burning hot for a while now. It comes in around 6% per year. So that's eye on. Housing expenses, depending on where you live, that might outrun our 3% average rate. Really depends on the zip code and taxes and where you're at in retirement. And lifestyle, that one's a little harder to put our finger on. It depends on where you want to go, what you want to do, and there again, where you're living in your retirement years. But one thing to keep in mind is when you're in your retirement years, your portfolio's invested, so there's still some growth. There's still some capital appreciation to keep these things covered as far as our expenses, healthcare and things that are always getting more expensive. So. Then we have market risk. I hit that quite a bit with the market volatility. The big thing is Amber mentioned sequence of return risk. What that means is if you take a withdrawal from your account, when say we go into a recession, market's down 20%, and you take a withdrawal, well, now we've just kind of locked in that loss, right? We took a withdrawal out when the market was down, and if that money is not invested in the financial markets and it can't accumulate or appreciate back, we've cut back on our performance a bit there. So that's where the timing comes in. So it helps to give us a call and say, hey, what should I do? The market's down, but I need some money. What do we do?
So this is a great graph that we like to use to just kind of show if you're having good investment results and you're underspending or spending to your plan, that's good. That's a good check mark. If you're having poor investment results and you're overspending, that's a no-no. You don't want to do that. So it's all about balancing and keeping track of where is the market. If we have high market returns, how do we take advantage of that gain? Okay. So again, taking those withdrawals during volatility, we want to try to avoid that. If you need the cash, you need the cash, but trying to leave that money in there as you can so that you have that available for when the market does rebound. Emotional decision making definitely increases when you're hearing all these negative things about the market and the S&P is down, the NASDAQ is down. It's okay. It will get better. You don't want to. And so a lot of people do like to do that, move to cash, like the market's going bad. Let's all go to cash, get out. That's probably one of the worst things to do during those times. Reducing your equity exposure. If the equities is what is going to make your portfolio grow the most. So if you're reducing that, you're reducing the potential growth for your portfolio. Tax. So some consider, I mentioned earlier, the required minimum distribution. So when you do take out your RMD, that's going to increase your income. That usually means it's increasing your tax bracket or how much you have to pay in tax, which then can affect how much of your Social Security is taxable. So it's never 100% taxable, but it can be up to 85% depending on where your income falls, which also can affect your Medicare premiums. So for that, so as your income increases, your taxes increase, your IRMA can increase, so you're paying more for your Medicare, and capital gains realization timing. So capital gains are taxed at a more favorable rate, but you want to make sure that you're kind of timing that when you're going to realize that when you're in maybe a lower income year, that might be the prime time to take advantage of that, as opposed to if you're expecting a large surplus to the year. So a successful retirement strategy, that is going to depend on how you're building your assets, where you're building them, what types of accounts, how you're structuring them, what your investments are in each account, and deploying those strategically, and again, adjusting over time. As you're getting closer to retirement, your needs are going to change, and that's when you can start to kind of swing back some of that strategic about where you are invested. While you're doing that, we're all keeping track of the longevity risk, the market risk, and the lifestyle risk. So it can be a lot to balance.
Okay, so takeaways, retirement and leading up to retirement, it's a journey, right? It's not like walking in the door at your employer one day and you're throwing the keys and you're done. There's a lot of planning that should be done long before you get to retirement to have the retirement that you've always envisioned. Um, your investment strategy never really disappears. It never goes away. It's always something that's going to have to be managed. And that's where advisors come in to really help take the pressure off so that we can do a lot of the heavy lifting when you're in your retirement years. Um, and then, like Amber mentioned, taxes in retirement, they can become as important as the return, because if you're paying too much in tax, you're functionally giving away more money than you should. One thing that is surprising to a lot of people is that even Social Security can be taxed at the state level as well. There's a handful of states that tax Social Security. So unfortunately, the tax man never goes away. Um, and then we talked about market volatility. We want to be careful with the timing of our distribution, falls in retirement. But like I said before, the key is having a flexible plan built and being able to adapt with the markets and with your spending plan if needed, both before retirement and in your retirement years.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just visit the description of this video and find the Schedule Your Consultation section. Thanks again for joining us. We'll see you in the next video.